Hello, one and all present here. This is Amit Kumar Singh, and welcome everyone to my session on financial market. So, what we're going to learn in this session, we're going to talk about financial markets. So, when we talk about financial market, in financial market, we are actually talking about the trading. Trading means buying and selling of different financial instrument. It can be stocks, it can be derivatives like futures and options, it can be currencies, it can be commodities. So when we talk about the financial market, the way the trading happens in the financial market, we're gonna comprehend the terms like impact cost. We're gonna talk about benchmarking indexes like Sensex, Nifty. We're gonna talk about how you can analyze the market by working on fundamental and technical analysis. We're gonna work on a lot of aspects here. So before we start talking about more and more here, let's start discussing about the theoretical framework what we have around us. So when we talk about financial market, what is important for us to understand is that how financial market works. And the whole idea of this working of financial market is the idea of capitalism. So how capitalism started and how it is connected with industrial revolution, you should able to understand the term. So the moment if I talk about the word called capitalism, so capitalism basically derived from the term called capital. So when we talk about capital, what is basically capital? You can talk about capital either in the form of equity or you can talk in the term of debt. Okay. So capital is basically the fund, what is required to work on an operation. So whenever we are working on an operation, whenever we are working on a business, we need funds. So those funds I can use by my own fund. If I'm using my own fund, that would be called as internal equity. Okay. Or what I can do, I can raise fund from the market. Okay, talking about how you can work on raising fund from the market and what is primary market, what is IPO, initial public offering, what is follow on public offering, right issues, bonus issues, stock split. We're going to talk about all of them henceforward. Right now, what you need to understand is that when we talk about capital, the capital can be raised either in the form of equity or you can raise capital in the form of debt. What is equity? Equity is all about raising fund from the market where in order to raise that fund from the market, we dilute our ownership. So whenever we are diluting our ownership to raise the fund, where we transfer our ownership to the end participants who become the owner of my enterprise, that way of raising fund is called as equity. The other way of raising fund is called as debt. So debt is all about borrowing money from the market for a definite time period. It can be short term, it can be long term. And whenever the funds are borrowed, it is borrowed with an obligation to pay back with interest. And the final value, which we call as a face value. Okay. So when you raise fund, either you raise fund by equity or you can raise fund by debt. And whenever these funds are being raised, okay, with this fund, what you do, you get the capital. With the capital, what you do, you work on getting a raw material. With getting the raw material, what we do, we process the raw material to have a finished good. When we have this finished good, what we do, we try to sell those finished good in the market to generate revenue for the firm. Once we have the revenue from the firm, ultimately we can work on developing a statement where ultimately the profit what we get, we either reinvest that profit or we distribute that profit to our reasonable holders who are all the owner of the company after paying off the interest. So ultimately, this is how the operation works. Okay, so once you get the capital, with the capital, you run an operation, you do all required kind of fixed asset development, and ultimately the output what you get, you sell and generate a revenue for the firm. That is how the business works. So the whole idea of working on capital so that that capital can ultimately create a value for yourself, that idea is basically the whole idea of how an organization or a firm works. So when we talk about the firm, basically here we are talking about private companies or we are talking about public companies. There we need to understand in the perspective of India, we need to talk in the term of Companies Act of 2003. And while understanding how the company works, basically we can get an idea of the reorganization and the development of a company. So when we talk about companies, how companies are ultimately creating the roadmap of a stock market, For that, we need to understand the term called primary market. We need to understand the term called secondary market. We'll talk about primary market and secondary market, how they're connected with equity, how the fund, how the not fund, how the firm raise capital by using the public issues, and how ultimately, in order to make the instrument or the equity issue as a liquid product, we have something called stock market. So stock market, please do not confuse with the accounting term called stock here. So stock, basically, when we talk about stock is basically raw material. So that ideology of raw material, please do not connect that the ideology of production operation management with the how the share market works around us. Here, what you need to understand, this stock market, what I'm talking about, it is basically, it's an intangible market where ultimately the liquid assets which the firm raise when they need fund, that liquid asset is ultimately sellable in the market. It is basically transacted in a medium which we call the stock exchanges in the form of shares. So here the word comes called shares. So we talk about what are shares, how the values of shares ultimately being determined in the market. We're going to talk about shares, the pricing of the share. We're going to talk about how this pricing of the share ultimately can create a value for yourself. So the term what you need to work on as per the ideology of financial market is that the stock market is the temple of capitalism. So this whole logic started with something called commodity market. Okay, we in India we had something called Bombay Cotton Trade Association, and from there we can see right now we have Bombay Stock Exchange. From Bombay Stock Exchange, now we have national stock exchanges. Okay, over Bombay Stock Exchange and national stock exchanges, we have heard of terms like Sensex, Nifty. We're gonna work and learn a lot of concepts here. So I'm super excited for this session. I believe you guys are also much more excited, and much more you're going to contribute to me, possibly while discussing here, and we'll try to understand how we can progressively can create a development of the market. Next thing, guys, here is that when you're trying to work on yourself, the very important term here is to work on investment. Okay, so overall, whatever earning we are developing at the end of the day, keeping that fund idle with ourselves does not yield any value. So the whole intention is that you should always park your fund in some form of avenues which can give you an ideal form of return. Return can be guaranteed return, it can be risky return, depending upon how the market is working on. But ultimately, you should generate some return, right? Keeping the fund idle yourself does not help you to beat the inflation. So always you should park your fund in certain avenues which can generate and give you returns. Okay, but very important fact what you need to understand here is that the return what you're getting from any financial product, that should be more than the inflation rate. Okay, imagine if the rate of inflation is 6 to 7% and you're parking your fund in a bank, which saving bank account, which is giving you 4% interest. That 4% interest will not help you to beat the inflation. What is inflation? Inflation is the economic term, okay, which basically talking about how your demand and supply is actually behaving above your purchasing power ability. So whenever we talk about inflation, inflation basically talks about how the goods and services whatever we are consuming, it prices are increasing with the period of time. So whenever you plan for your investment, you should always invest your money in such a way that you should always get a return more than the inflation. Okay, we'll discuss about this. So that is the primarily logic of working on an investment. So the best investment what you can do with yourself is to make yourself aware about all this. Make yourself aware and make you educate yourself with more and more with financial market around yourself. The more you get yourself educated, the more you can contribute to the economic development. In India, hardly 4% of people are actually participating in the financial market. So that is actually a very depressing statement. Again, it is very optimistic statement. It's which shows that yeah, we if people like us, if we contribute more, if we invest more, possibly right now the Sensex Nifty, what we are seeing around 21,000 or 71,000, we can contribute it into the development. And ultimately, when this Sensex or Nifty will start rising, possibly the return what we make that will ultimately help and together the society to get the same form of return. So that is what the idea of investment is all about. So next statement, what is important here, if you read here, you can get to know that right now what is happening with the Sensex. Okay, Sensex right now is around 71,000. The day when I'm recording this video, right on this day, Sensex is trading around 71,000, while Nifty is around 21,000. And people are speculating that most probably the Sensex might reach 1 lakh by 2026. So this is the end of 2023. So basically, next 2 years, you will see Sensex crossing 1 lakh. Okay, and please don't get surprised if you see this statement, because it's very much possible. So the base year of Sensex was 1979, where we considered the total market capitalization as per on that date. Okay, Sensex is basically, it's a portfolio of top 30 companies. Okay, that time the top 30 companies may be Bombay Dyeing or HMT or maybe Wipro or Reliance Industries, Reliance. So those were mainly the top 30 companies at that time. Many were there. Many of those companies might not be existing right now, but Sensex is there. So Sensex is a dynamic portfolio. Okay, so when we talk about this Sensex considering an portfolio of top 30 blue chips company, while Nifty is a portfolio of top 50 blue chips companies. So the Sensex, which base year was 1979, when it was around 100. Okay, it benchmark value, it crossed to 148. You can see by 1980 it became 148, and then by 1990 it climbed to 1,000 point, and then it went to 3,900 point, and there progressively you can see the way the Sensex has actually performed with the period of time. And the major contributor of all these movement, what you're seeing is basically the FIIs, foreign institutional investors. So these FIIs, they invest in developing or emerging economies, be it China or India or Brazil or Russia. So they primarily look for these emerging economies. And in our country also, after LPG was implemented in 1991, okay, when PV Narasimha Rao was the prime minister and Dr. Manmohan Singh was the our finance minister, after that we saw a huge momentum shift in the way the Sensex and Nifty has actually performed. Okay, so basically right now, if I'm seeing in the current state, how our market is actually progressing. Okay, so you can see the major contributor are FIIs, where in December 2023 only they have invested around 57,300 crore, where you with this you can see that altogether in this year they have invested more than, possibly more than 1.5 lakh crore in the market. So this shows the faith of foreign investors over the Indian economy. Although if you see our counterpart, Chinese economy is actually struggling a lot. So there are many reasons of the struggling of Chinese economy. Maybe they have not come out of the COVID crisis. Again, the new variant of COVID has came, and it's again creating kind of what do you say, miscommunication and mistrust among lakhs of thousands of investors around us. But still you can see again, and another possibility of investment is coming. Okay, if you see market coming down, so you don't have to get scared on that way. Possibly that will create an another dynamic shift of how your market can work. 2020, when market has actually crashed down to 8,000, that time nobody has thought that Nifty will again reach 21,000. So this is how the market works. So like after dot-com bubble also the market has crashed. In 2008, after subprime crisis also the market has fall down, Lehman Brother crisis and all. Again, these things keep happening, the market goes ups and down. So but you don't have to get panic. You have to see when there's a possibility to buy. When you see the market is falling down, that time it's an ideal environment for an investor to buy in the market. And when you see the market is going up, possibly when you see bigger IPOs are coming, like in 2008, if I'm not incorrect, in January 2008, Reliance Power has actually came up with an IPO of around 11,700 crore. So that was the time when most of the investors should come out from the market, because it was kind of overbought region. Okay, again in 2000 10, if I'm not wrong, Coal India came up with around 15,000 crore IPO. So again, that shows the region of scenario of overbought possibility. So whenever you see such kind of bigger IPOs are coming in the market, that create an ideal space where you can come out from your investment. And when you see the market is falling down, that create an ideal investment scenario for all of us. So you can see, guys, that Nifty or Sensex, like Sensex, imagine if I have done investment in 1979. In 1979, imagine 1 minute. Imagine if I had done investment in 1979, that time Sensex was around how much? It was around 100, right? Sensex was trading around in 100. So in 1979, Sensex was around 100. Okay. And right now, if you see Sensex was around 100. Right now, if you see Sensex 2023, Sensex is trading around what? Sensex is trading at 71,000. So imagine that time if you had done investment, how much return you would have got by this time. So anyway, I'm trying to create an ideal environment for all of us, that more you invest in the market, more you try to track market by investing in ETF or maybe in some index funds, the more there's a possibility that you can get a better return from the market. Return of maybe 18 to 19% is very ideal. You can get very easily by simply tracking the indexes like Sensex or Nifty. So basically, what I'm trying to talk about here, that FIIs basically include foreign institutional investors, which include foreign mutual fund companies, foreign banks, foreign provident fund companies, foreign private equity firms. They are aggressively right now investing in Indian economy. The primary region can be the way one political party has actually won election in 3 out of 4 states in India. So, and again, next year there are two bigger elections are coming in the world, one in US, another one in India. And because this party has actually won in 3 states out of the 4 states, so that shows the possibility that next year again the same political party will come in picture. So because of which because of this more stability, political stability, what FIIs can see in India, because of the way the Indian economies, the possibility of the growth of Indian economy is there, that all shows a momentum shift of investment by developed economy into developing economies like India. Although our competitor China is struggling with COVID crisis, is struggling with housing bubble crisis. So China have his own region, because of which you see a kind of huge volatility in the commodity market. But altogether, when we see the growth prospects of India is much more brighter as compared to the other economies. So going further, if we discuss 1 minute, so you can easily understand, like if you see the GDP data of India, so it is trading around, GDP of India is around $350 trillion. And if you see the market capitalization of top 30 and top 50 companies, so you can say that market cap to GDP ratio is around 1.15. That shows an ideal investment opportunity in country like India. That shows our GDP and the way our stock market is actually performing. They are performing much more in very positively correlated way. So if you see the way the census has actually progressed over the year, you can see the cumulative, how much return we can see we could have easily generated. Imagine if we have simply tracked the indexes. Okay, this is how our Indian market has actually performed with the period of time. Here you can see basically the correlation between Fed rate and the RBI rate. So generally people want to understand how US economies is actually performing with respect to the Indian economy. So you can see more or less from 2019 to 2023, the repo rate of RBI is not much changed. It is actually fall down and again it went back. So So repo rate basically talks about a rate at which basically the bank borrows when they need fund from the RBI. So a higher repo rate means a higher prospect of growth or higher cost of financing, and a higher cost of financing means higher WACC rate, which ultimately will decrease your IIR or NPV values if you are working on capital budgeting principle. But at the same time, it shows that if you are investing in bank or if you're putting money in FDs and all, you are getting better return. So again, it varies from investor to investor how they perceive the momentum in the market. If you see the US Fed rate, it was in 2019. Okay, it was around 2.5. Okay, so it was 2.5 there. So from 2.5, it has actually fall down, and now it is going up. So that shows a kind of momentum shift in the way the US market is actually supporting themselves a better employment data, or a reduced inflation value, or a decrease in the bond end. So all that is actually progressing, or that all that is actually motivating FIIs to borrow money from the US market, and the same can be Indian invested in the Indian market, where Indian market, which is actually is showing much more stability in the interest rate, because this time also in December, when the monetary policy review was done by RBI, they have not changed the repo rate. So that shows that RBI is actually believing on holding and working on better opportunity in the market, where RBI is much more optimistic about the Indian financial market scenarios. They are not much scared about inflation data, although in December, inflation data of India shows an increase of food inflation. But RBI is much more right now believe that these problems are not much will be in the longer run. There's a huge prospect of growth of Indian economy, although this Russia-Ukraine war or Israel-Hamas war is actually creating an food inflation all over the world, not only in India. And India, which is the food basket of the world, is trying to support all over the world economies. Although India somehow in between try to reduce their export of food products so that they should curb food inflation in our country. But these all are seasonal fluctuation that will keep happening ourselves in our economies, and that will not much impact the inflation or the prospect of growth around us. So when we talk about the how the Indian economy is actually working around us, so you can see this year Indian economy is actually just increased by 18%. While if you talk about US economy, or if you talk about Japanese Nikkei 225 is the Japanese stock exchange. So actually US and Japanese economies has actually performed better than emerging economies like India or China or South Africa or Brazil. So Brazil or South Africa have their own problems. I'm not going to talk about that. So basically, if you talk about the world GDP data, the way the growth rate has actually performed, although the base effect is actually affecting these values, what you're seeing 4.8 to 4.9 of GDP growth rate, what you're seeing in US or in Japanese economy, that is a good prospect. Because if you talk about debt to GDP ratio, so the world highest debt to GDP ratios is actually created by Japan and US only. Although India debt to GDP ratio is again a concern factor for the IMF and other political think tank. But even then, India being a developing economy, if we have little bit higher debt to equity ratio, not debt to equity ratio, debt to GDP ratio also, then also it's not much concern for us, because we are seeing India is growing around 18%. So that is actually a positive news about India, because you know about something called leverage. So with more debt and all, uh, uh, which India is actually borrowing from the international organization, these debt is ultimately being utilized by companies like Adani's or Reliance Industry or Tata in the growth momentum of themselves. Because ultimately, when we are talking about growth, so growth is basically depends on return on equity into retention ratio. Sorry. So it's basically depend on return on equity into retention ratio, and this retention ratio is retained earning by profit after tax. So because the Indian market is booming, because we are seeing Sensex or Nifty trading beyond 18 to 20 thoughts percent. Okay, so possibly you are seeing the possibility of growth in countries like the economies of Indian companies here. So if they borrow money from the market and use that for the growth of the economy also, that is a good sign. Ultimately, you know the term when we talk about leverage, there's something called financial leverage, there's something called operating leverage. So financial leverage is basically talking about this possibility only, where if you are getting a return on equity which is higher than your rate of interest, ultimately your EPS, earning per share, will rise up significantly, and that is what is actually happening with the Indian companies. Okay, so here you can see the Sensex, which was around 100 or 148 in 1980s, how it has actually performed in last so many years. So you can see so you can see period on period basis, there's a very high growth rate in indexes like Sensex or Nifty. Here I have spoken about how the indexes is actually performing, and don't get surprised if you see Sensex crossing 1 lakh by 2026, because that is very much is certain in the current state of the economic movement. Okay, now talking about the same GDP story, I have mentioned that the current GDP of India is estimated around 3.2 to 3.3 trillion dollar. Okay, where if I talk about the market value of the top 50 companies in our country, okay, top 50, the Nifty blue chips company, you can see the market values is around 1.8 to 2 trillion dollar. And if I take the market capitalization of all the company, it is around 3.5 trillion dollar. So if you take the ratio of market cap by GDP, so it will come around 1.15. So ideally, it is one is the ideal ratio of market cap to GDP. But you don't have to get panic if you're seeing market cap to GDP of India around 1.15. Most probably, the market is very much optimistic over the Indian market, and they believe that very soon these all will discount itself, where very soon we'll see a higher GDP value, because IMF, World Bank, and other economists are actually predicting that India might cross 7 to 8% of growth rate. Maybe next year many think tank are not very optimistic. They believe that next year the growth rate would be around 6 to 6.5%, probably because of the world economies, because of the way the political or what you say economic unrest is happening. Like Iran is right now creating problem in Mediterranean Sea, where China is planning of again nuclear test very soon. Okay, the Israel Hamas war is happening. Russia is again getting more and more aggressive. The G20 summit or Quad summit has not come up with very positive outlook. So some problems are happening around us. But as per what Benjamin Graham said, that Mr. Market is a very rational person. Sometimes it behave like a drunkard, but it knows how to correct itself. So we need to have a belief on that perspective. And very soon we'll see Sensex, which is right now trading around 71,000. Very soon we'll see Sensex might cross 1 lakh also, and we don't have to get surprised if we see that parameter. So I hope you have understood the framework what we are discussing right now. So far we were basically talking about the growth what we can see over the Indian financial market. So Indian financial market can belongs to instrument like equity or derivatives or currencies or commodity. Primarily when we talk about equity, we are talking about cash market. We are talking about how you can actually buy and sell shares. Okay, so shares basically represent per unit ownership of a company, which we can actually transact once the company has done the IPO and once they have listed themselves on the market, so then we can actually buy and sell their ownership, and that way we can generate value for ourselves. So there's something called market capitalization. So market capitalization basically means market price per share. So market price per share into number of share outstanding. Market price per share into number of shares outstanding. Number of share outstanding means how many shares are there in the market for trading purpose. So I can request you that you can get some knowledge about what is free float market capitalization. So just now I have mentioned something called market capitalization. Please do some research and get to know about what is free float market capitalization, what is free float factor, and how they contribute in the determination of Sensex and Nifty values. So when we are seeing Nifty is trading around 21,000 or Sensex is around 71,000, I want you to do research and get to know how this 71,000 or how this 21,000 figure has actually came. So with that intention that you'll do more research on the market, you can come back to me in case of any doubt what you have. It's time that I should wind up this session, and more we discuss about how our market is actually working on, how this financial market is altogether progress for the development of Indian economy, and how these all are connected with us as an investor. We'll discuss more in the next session. So I don't want to increase the width and the timing of this one session. So with that faith, I'm winding up this session. Thank you, everyone. I'll see you very soon in the next session. Take care. Bye, everyone.